All right. Good afternoon, everybody. Happy New Year. Apparently, over the last couple weeks, I've forgotten how to start a Zoom. You would think after doing, hundreds of these that we know how to do this by now. But happy to have with us Brandon Polakoff, fellow principal here, and our executive director of Tri-State Investment Sales, and Ashley Cole, our senior analyst, joining today to present our state of the market. So we will jump right into this because I want to make sure that we have time to answer questions as well. And we do want this to be interactive, and we'll certainly share copies of this report with you after. There will also be a recording. But if you have any questions, just go ahead and put that in the Q&A, and happy to answer them along the way or afterwards. Okay, so let's go ahead and jump into the state of the market for the fourth quarter. Okay, perfect. So hopefully you all can see that. I already did introductions, and let's jump right into our investment sales figures for 2022. Okay, so we are looking at fourth quarter sales here for New York City. These are all asset classes, predominantly multifamily, retail, office, and development. And we break them out by borough. So when we report the fourth quarter, we compare it to the previous 4 quarters. So unfortunately, you do see a drop across the board in sales volume. I don't think that's going to surprise any of you all. We have a 32% drop in Manhattan sales at $3.3 billion. We have a 6% drop of $1.1 billion for Brooklyn, 45% for Queens, 77% for the Bronx, 72% for Upper Manhattan. So if you look at how the fourth quarter performed, we're down 31% over the average. So we look at where that amounts to at $23 billion, and you can see off certainly the 10-year average. Now, that being said, there was a pickup in the amount of dollar volume from 2021 to 2022. And so New York City, there was almost a 50% increase in the dollar volume from 21 to 2022. But we'll see that was really driven by large transactions that took place in the first half of last year before rates started going up. So we'll now look at what happened with the number of sales that took place. So Manhattan dropped 12% less sales in the fourth quarter compared to the trailing 4. Brooklyn was the only one that showed a marginal uptick with 2%. Queens down 10%, the Bronx down 65%, Upper Manhattan down 63%. So if you look at the annual average of 1,000 sales per year in the city, we were just above half that. Again, we did see an uptick in 2021 to 2022, going from 502 sales to 574 sales, but no doubt, again, that was really driven by the sales that took place in large part at the beginning of the year. Okay, so now we will jump into multifamily sales. And Brandon, I'm going to go ahead and pass this over to you if you want to talk about your observations with the multifamily sector. Brandon, I'm not sure if we can hear you. Ashley, are you having trouble hearing Brandon as well? Okay. I see Brandon. You know what? We might, for whatever reason, he's coming into my office, so we'll have him join me in here. That's fine. That's right. We'll roll with it. You can see that we're actually in the office. We're together. So everybody, welcome Brandon Polakoff. Nice to see you. That's all right. Have a seat, and that's fine. Let's go ahead and talk to these numbers. So
sure. Sorry about that. Yeah. So I think generally speaking, I guess we can backtrack a little bit into early 2022 and then kind of see how we progressed into the later portion of the year. So in early 2022, we saw sales volume pick up. And as you can see in the overall numbers from the historical multifamily pricing section, we saw cap rates come down and we saw price per foot jump up. The reason for this was there was a lot of optimism in the multifamily space. Rents were climbing at rapid clips. Interest rates were very low. You could borrow money in the threes. And we saw a huge drive of demand towards this. I think also, if people forget that in 2020, there was all this talk of good cause eviction that kind of started to grow fear amongst investors. And I think in last January's State of Her State address, Governor Hochul really calmed down that sentiment and that she wasn't supportive of it. So I think that also gave investors a lot of confidence. As we progressed through the year, really, we started to see it in June. Interest rates started to tick up. Now, there was some offsetting of what was happening with the interest rate environment, because last summer, if you looked at, especially we look at rent rolls day in, day out, and what you saw a lot of was the new rents that were being signed were still substantially higher than even prior months, and especially 2021. So investors were still able to offset a little bit of this mortgage rate increases by the increase in rents projected. What you eventually saw is the rental market, not that it cooled off, but it plateaued a little bit. And I think one thing that I think is overlooked by a lot of people that I speak to today is they're saying, hey, look, the rental market's softer. I think they forget that, the COVID year or years, I should say, was kind of an enigma. The rental cycles were thrown into flux. So yeah, last year we were seeing rents in December signed higher than, call it, the summertime, but we were also in a new world. Now, right now, it's the winter time. Look, historically, that is when rents are soft. It is part of the rental cycle. We're back into more of a normal cycle. And I think a lot of people are overlooking that fact. But putting that aside, rates started to climb dramatically, as we all know. Again, just to make it clear, the Fed rate is not the rate charged to borrowers on mortgages, but that's a whole nother conversation. With that being said, those rates also climbed. Though over the last few months, they've kind of leveled out a little bit. And what you saw was in the fourth quarter, as rates climbed and people started becoming uncertain of the future. Again, underwriting is just a prediction of the future. And really what happened was buyers thought, or think still, that things are going to get worse before they get better. So no one wants to catch a falling knife. They say, look, I don't need to invest right now. Let me wait a little bit. What happened? There was less sales. So because pricing started to dip and people started to wait, there's, as you can see, there's 38 less sales. Cap rates started to rise again. The price per foot came down and total dollar volume came down, especially, these large scale transactions that involve a lot of debt. They got hit the hardest because these rely so much on those extra dollars that you can borrow and the cost that that you're charged to borrow it. So I can say anecdotally, and this isn't reflected in this chart, there was a lot of sales. Now, I think if you were to ask James or myself or anyone on our team, how we're seeing things today, I think we would say from a contract signing standpoint, it has definitely gotten more challenging. We've definitely needed to have more competition than we ever have to ensure that we can get sales over the finish line. If we're negotiating in a vacuum, it's just difficult because right now we're just in this market where buyers feel that they have all the leverage, not to mention there's just less borrowers because there's less equity chasing deals right now. With that being said, a lot of sales that were taking place in Q4, they were signed in Q3, Q2. There was long closing periods as people tried to figure out what was going on in the lending environment, especially the banks were taking their time. So we, ourselves had sales close in December where we signed a contract in June. And the sale, the closing got delayed a little bit. We got them over the finish line and we were successful, but we also had hard deposits in the seller's escrow account. So that definitely helped. As we move into 2023, again, anecdotally can say we are still signing contracts. That's the positive news. It's not just a completely frozen market, but pricing has been adjusted. There's a lot of property on the market right now in the multifamily space. So there's a lot of competition amongst sellers chasing, you know, a small pool of outlier buyers that are willing to pay a premium, especially for renovated product. And on the value add side, again, I know a lot of sponsors are out there looking for equity. You know, who's going to dive in here with me, seeing this opportunity? To me personally, and I'm sure to our team in general, you know, a lot of us were here. If you look at this historical multifamily pricing chart, we were here in 2012. We saw, you know, and you can see it. It's a peak, it's a trough, it's a peak, and we're sitting here today, and we're scratching our heads. Again, if you're a believer in New York City long term, even with the higher cost of capital, you know, you might have bought a property in 2015 with a lower cost of capital, but guess what? You know, you're probably under, not necessarily, but you're probably pretty close to break even right now after you spent a lot of time and money. So I think just the value proposition, I think people need to recognize it. And people have short memories. You know, COVID was quick, and I think this rate environment, who knows how long it's going to last. But if you see a good opportunity, you have to keep betting on New York if you're interested in buying. So again, pick and choose, but there's definitely opportunities coming in 2023.
Thanks, Brandon. So wanted to ask you, because one thing that is pretty telling, you see the cap rate expansion that is now taking place. And I know we've all been feeling this on the brokerage front, and certainly hearing this from investors, but you finally see cap rates expand up to close to 5%. Now, that's just for the fourth quarter over these 38 sales, whereas the 4.5% that you're seeing on the right side of the screen, this is the average over the years. So clearly you're seeing cap rate expansion. Now, this is just a barometer, right? So this is going to include rent regulated and fair market. So I'll go ahead and ask the question, because if not, I'm sure we're going to get it anyways. But Brandon, what is the difference in the cap rate if it's all fair market, if it's fully regulated, or if it's 50-50?
Sure. So I think if you're looking at, I think the general, one thing I would definitely mention, and I want to quickly just preface this, is that when you're selling multifamily product, I can just say anecdotally, I would say anecdotally, but there is just far more buyers looking for fair market product than there are rent stabilized products. So what does that do? There's almost like a doubling effect on the cap rate, where for the small group of buyers that'll buy 50% rent stabilized or fully rent stabilized, the challenge that you have with those buildings is that, you know, when we sell fair market value add building, there's an exit strategy to these operators that we're selling to. They want to go in, they want to renovate, and they want to sell. They also are sophisticated enough to know that when you're selling renovated product, the buyers of that product are generally high net worth individuals, foreign investors, 1031 buyers. They don't want to touch rent stabilized. So it's really hard to exit 50% rent stabilized, fully rent stabilized. With that being said, that's where the value is. So, you know, we've seen, you know, 100 basis points, 200 basis points in spread between the two products. And it's just a different pool of investors. I think in the rent stabilized, 50% rent stabilized space, it's going to be more long-term investors, someone that's going to hold it on, generational. Maybe the politics change and it's a good basis. Whereas the fully fair market stuff, that is something where an investor is looking for 100 basis points spread when they exit. So they're today seeing that renovated product, let's say on average trades for a 5.5 cap in Manhattan per se, or in Brooklyn, maybe 5.5 to 6. So what do they need to do? They're taking that, the going in cap rate is almost irrelevant because it's a metric of, it's not really a metric of the upside. So they're determining how much upside's in the building. Can I build this to a 6.5% yield on cost? And if I can, what's my price? Because I'm expecting that I'm going to sell it at a 5.5. Again, if you were to ask me this question 6 months ago in May, or I guess June now, at that time, we were selling finished product at a 4.5 cap. So buyers were trying to build to a 5.5 cap. And that's been the shift in the value add pricing is the yield on cost that buyers are solving for. And again, they might also feel more bullish, but they need an equity partner that will go into the deal with them. And this is what the equity partners are requiring right now. Unless it's your own money, that you have to follow the lead of the money. So that's
no, it's very, very helpful. It's certainly important to make the distinction. So we did have someone who raised their hand in the audience, but just if you don't mind, send us a question on the Q&A or the chat. We'll keep moving here. Let's talk about some of the top multifamily sales that happened this past quarter. So Brandon,
sure. Yeah, and I know I've been long, so I'll rip through these. So the properties on East 61st, York Avenue, East 72nd Street, I've actually personally been to them. Gorgeous properties. You walk in, there's 3 people holding the door for you. I have a friend that lives in one of the properties, very nicely renovated units. This was purchased by Josh Gottlieb, Mayor Orbach, and plenty of investors. One thing to note here, I don't know. I think generally speaking, there's an opportunity here based on how these properties were being run to increase rents and decrease expenses. And I think that's the vision for those properties. There's no one's going in and doing substantial work there. 298 Mulberry Street. This was purchased actually by Empire State Realty Trust with a 1031 exchange. And I tell you, they really wanted something that was cash flowing. They bought this with no debt. It was a very low cap rate. It was in the low 4s. It was a higher price per foot. But look, it's an irreplaceable location. You're always going to have tenants there. You have CVS on the ground floor. My sister actually used to live in this building probably 15 years ago, and they had a billiards hall on the ground floor. But yeah, it's almost a coupon clipper. It's irreplaceable, great location, great asset. And then 138 East 12th Street. This one was a good sign of the times. I mean, this one was purchased a few years back. It's got West Side Market on the ground floor. I would say it's probably the highest rents in the East Village. I have to double check, but I'm 90% sure that or Cooper Square, which is also on a ground lease. Highest rents. This is the Nathaniel. This was purchased again on a ground lease. There was a substantial loss. I forget exactly what it sold for, a handful, like in maybe 2017, but this was actually, if you look at the numbers on the ground lease, I mean, this was like a 6.5 cap. So again, I think that goes to show, I think the ground lease aspect of it definitely adds another 50 or so basis points to the spread, maybe a little bit more, but that's what it took to get this sale done in this rate environment. So yeah.
Great. So one of the questions we did receive was, does your Q4 cap rates include the solo portfolio, which seemed like a 3 cap? So yes, this is the solo portfolio here. If you have information that this was a 3 cap, I don't know if we were able to verify that or not. That would seem like a pretty tight cap rate to me.
It would seem pretty tight. We can definitely double check there. Again, there was a plan to substantially reduce expenses and increase the rent roll. Again, underwriting is a basis of assumption. So even if it was a going in 3 cap, if someone sees upside, however that may look, again, they're looking to build to something. And also, we would need to really understand when that contract got signed, which again is homework that I need to do, because they might have been able to lock in a much lower interest rate at the time. And there was a period of time where these properties were selling to build into the low 4s to get to that. I mean, that's where these properties were trading, a year ago. It was let's get this to a low 4 cap. So if they saw a path to getting there and they had the right debt in place, it actually would make sense.
Mm-hmm. So this was one of the, I mentioned initially, there was the top 10 transactions. It's our belief that 9 of those were all signed before rates began to go up. So this was the one sale that took place in November, presumably contracted after rates began to go up. So if that was a 3 cap, that would be a pretty impressive sale result, all things considered. I've got to
For sure.
imagine,
There's
again,
gotta
the
be
base
more to
that,
it,
yeah, basis quality of assets. So, and Zach, we'll get to your question on the development as soon as we cover that asset class. So,
Yeah, and I'll quickly rip through this because I know Ashley has some great, things to share on the future of New York City. But effectively, this is just showing, and this kind of ties to the question we just got asked about 421A. Why do we believe that rents are going to keep climbing and that there's an opportunity? There is no product. There's no supply of apartments, as we all know. It's, you don't have to read. You can read the news and you'll read exactly what we're reading. We have a serious supply issue in New York City and an affordability issue. Until we can solve for that, which, by the way, even if we solve for that, it's not happening overnight, right? So even if everything goes through the legislative process and we're able to figure out ways to create housing, you don't just create housing by, snapping your fingers. It takes time to get that through legislation, and then you actually have to buy it and you have to build it. So for the foreseeable future, there is an extreme lack of supply in apartments. And as we all know, people want to live here and the demand is high, and that is what's going to keep rent steady. I beg people to continue to watch the rental numbers and stop telling us it's a soft market. Again, it's December, it's January. This is exactly what happens year in, year out. And it's just a cyclical rental cycle. And I think that people forget that. Again, it goes back to short memories. Let's think of 2019, 2018. This is very standard. So I'll be interested to see where rents start to look like in May, June, July, August, as we do every year when they climb again. So
great point. And I know Ashley's going to get to our mayor's moonshot plan, and Rebney has also said that they expect we're going to need over 500,000 new housing units by 2030. And if you can see, now this is just Manhattan. This is not looking at all New York City, and we can certainly bring that information to you for the city next time. But just as it relates to Manhattan, you can see back in 2014, over 12,000 new units were brought to market. And, since COVID, 2021, that was kind of maybe the tail end of
trying to get
the
the 421A.
421A. Yeah. But other than that, 3,000 units, 2,000 units. So,
and by the way, 2016 was when, isn't that when 421A originally expired? It was 2016, right? It was 5-6 years ago. I mean, and you see how long that the numbers zapped, after when the 421A was originally in flux back in 2016.
Mm-hmm. So here's the filings, just so you see on the number of units in this. Okay, so we do have New York City. Great. I'm glad we included this one. So you can see, at a peak, bringing 45,000, 33,000 units. And the last few years, it's been in the mid 20,000. So that's certainly, if we're only adding that many units per year, that there's no way we're going to get to the 500,000 needed. Okay, so let's talk about land sales. With that, you see that land prices in Manhattan have gone down from really a peak of 681 to 409 a foot. Only 8 sales for an average in the fourth quarter of 330 a buildable foot. The average for the year was 409 a foot. You look at the kind of sales that are taking place, certainly the one on the Lower East Side with Clinton, you're seeing these are more rental sites. You are still seeing some examples of condo development on the Upper East Side, but in large part, the type of land that's being sold right now is either going to be going for affordable condos or rental, which is, again, without the 421A. So we have some developers who are willing to do that. Again, it comes back to
the
basics.
price per buildable. Yeah, it all comes back to basics. I mean, the Upper East Side, and that was obviously a family that purchased this. For what it's worth, I spoke with them. They had offered $20 million more a couple of years ago. So just to give, again, that sense of where we are. But again, when you're looking at these rental sites, I can say in the last quarter, a lot of these sales were actually happening, sub $400 a buildable foot, which I think if we have like the historical dollar per buildable, we're just seeing a slowdown in that market. I think a lot of that's the construction financing costs and the the prohibitions on what you can do there.
For sure. Okay, so now we'll look at retail. In retail, we've seen the most dramatic expansion on cap rates at 6.3%. for the year, the average, or excuse me, the last quarter was 6.58%. The average for the year at 6.3. Price per foot. The price per foot really depends on where these assets sold. So when you start mixing in side streets with, prime, Soho, Midtown, but I think the cap rate is pretty telling that finally, and we are going to look at a comparison with the various asset classes and what cap rates are doing. You're starting to see some differentiation because retail, again, in theory, has more risk than multifamily, so it should offer a higher yield. So I think this is a very attractive space to consider right now. And if you look at the type of retail that's trading right now, certainly we're seeing some interesting transactions, opportunities down on Green Street, this 102 Green Street. If I'm not mistaken, this was leased by Cartier, brand new 10-year lease at a 6.5 cap. And I think when investors hear that, that is really, if we're talking about credit, fashion, Soho, 6.5 cap new lease, that really
That was eye-opening.
Yeah, eye-opening for a lot of people for sure. That being said, it was kind of a pseudo off-market deal in that it was part of a larger portfolio. That's the value attributed, but still pretty impressive. And then the corner here on the Upper West Side on Broadway, yeah, and short-term lease with Staples, but the buyer there is confident that they'll be able to relocate them and free up some additional space. So excited about that. And then some more kind of neighborhood retail that sold on the 86th Street. And I did speak to some retail brokers last week, and some of these corridors, the retail has really bounced back, and in some cases is now even at levels that were pre-COVID. So that is a reason for optimism when it comes to retail rents. Okay, so last but not least, office sales, which is one that continues to, when you look at this cap rate, it's really been pretty stable and hanging in there. And when I gave my interview to BizNow, the one thing I asked them, I said, well, look, you can obviously print this, but you really have to add the disclaimer here. When we see that the average price per foot in the fourth quarter dropped 53% from the trailing 4 quarters, I said, look, that is really not a fair statement to make, because here we have, this is only over 8 sales. And what you're doing is you're blending, you're averaging class A, B, C, and trophy. So if this is just a result of, in this case, you'd say, well, James, these addresses look, pretty good. I mean, 1330 Avenue of the Americas. Now, if I'm not mistaken, this was a 6 cap, even though it was only
60% lease.
Yeah.
We've got 225th Avenue. That was a lease with an option to buy, struck years ago. The option was exercised. And then 175 Water. Don't want to talk too much about this, but this was taken back by the mezz lender. They resold this, and this was AIG's headquarters. It was 50%. They were originally going to do 50% resi with 50% office, abandon the plans, but that's going to be a residential conversion now, which is right next to 180 Water Street, which is a residential conversion. You've got 20 Broad down there. Obviously, you have a couple things in the pipeline with Nathan Berman downtown and his partners. So
GFP's purchase.
GFP with Nathan, and Silverstein
and some of those were sub 400, even sub 300.
Very cheap bricks.
So that's where you start seeing the dip in average. But that's not to say that the trophy is worth in the mid 400s a foot. That would be
this is for
that
vacant,
would be misleading.
Yeah, vacant product, exactly.
Okay, so these are the top sales for 2022. Again, all but one of them being negotiated in the first half of the year, with Google's purchase of 550 Washington Street, St. John's, for almost $2 billion, 8 Spruce, which was Brookfield's sale to Blackstone. You've got the Disney campus, which was purchased by Extel. You have the American Copper buildings, again, bought by Josh Gottlieb and Mayor Orbach. They are on certainly a tear. You've got the rest of the solo properties that we discussed, and then looking at some other multifamily downtown that was bought by
the Ford investor.
Yes, 450 Park Avenue, and then Riverside Boulevard, another solo property, and then a development site to round it out. So those are your top 10 sales for the year. Okay, so looking at the 5-year historical pricing and just asset by asset. Again, what amazes us is how certainly office has held in there, is kind of held its ground. If you even look where it was priced on average 2018 until today, you're not seeing much difference. Whereas, retail has been volatile to say the least. And you could say that's because there's not enough sales and you have these huge swings. Whereas multifamily compressed and is actually showing some signs of strength. And again, that goes to what type of assets are selling. Are these regulated assets? Are these more, fair market trophy type assets, and land, seeming to stabilize. So that just kind of gives you a sense as you compare these together. Okay. And then cap rate, again, same kind of story where multifamily and office, certainly we saw some compression and now we're starting to see some expansion, and it's really been retail again, which is starting to really show some significant cap rate expansion. So with that, Ashley, we'll turn it over to you.
Thanks. So switching gears here a little bit, I'm going to cover the new New York plan, which was a joint city and state proposal that was published at the end of last year. And this 3-part action plan is comprised of 40 different initiatives outlining all the goals of, the city and state over the next decade or so. So the first major goal that they outline is reimagining New York's business districts as vibrant 24/7 destinations. And the major strategy under this goal is to create flexibility to repurpose space and fill vacancies with a variety of uses. So, it's no surprise to anyone that the office market was hit particularly hard by COVID. And it seemed that the pandemic really revealed the rigidness of the existing zoning code. And so the goal here is really to make it more flexible for business districts to continue evolving and become more dynamic neighborhoods. And so in order for this to happen, there needs to be a modernization of outdated regulations and a reduction of the current barriers to entry in order to allow this housing growth to really happen. So specifically as it relates to conversions, in Midtown today, as the zoning code is written, office buildings have to have been built before 1961 to be eligible for conversion. And so the goal here is to refresh this, the way this is written, so the cutoff threshold actually is extended to December 1990. And just that one change alone would bring over 120 million square feet of office space, unlock that potential for those conversions, which would be really, really massive. There's also discussion of potential tax incentives to help these conversions really be able to pencil, with the increased NOI and the increased tax rate that come with converting from office to residential, as well as the inability to pass through some of that tax liability like you can in a commercial building. The government recognizes that in order for these to be really feasible, there likely needs to be some sort of tax incentive there as well.
Ashley, not to stop you there, but just to underscore that point. And first of all, it's really great to know that this, office to residential conversion is a top priority at the city and the state level. That being said, they do allude to the need for a tax abatement, but we are still waiting clearly for a new 421A for ground up, let alone an abatement for a conversion. And
Right.
By our estimation, out of the 78 office buildings which have sold since COVID, to our knowledge, only 3 of them have been converted to residential. Okay, and we could talk about why have only 3 buildings been converted to residential when the availability rate in the city is 20%, constituting 100 million square feet. And first you could say, well, zoning, clearly. So you can't convert a building if it does not have residential zoning, unless if you do a spot rezoning. So it's good to hear that the plan certainly addresses that. The next is the floor plate, where again, if you have a large floor plate, you might not have the proper light and air. You might have to core out the property. Clearly, this plan will talk about some flexibility in that regard. But in my mind, last and most importantly is the financial benefit. And unless it makes sense financially to do this, meaning you have to buy the property for the right price, and no doubt an abatement can help facilitate and make that possible. The fact that we have not had a program yet like a 421G, which was really cited as what saved downtown, is probably a big reason why, again, we've only seen 3 of these conversions to date. So I just wanted to point that out, but keep going, please.
Thanks. So just the three other main strategies under this first goal here are continuing to invest in beautiful and permanent public space, as well as, sharpening up what does exist now in New York City and really making those spaces more world-class. Improving quality of life issues, and this includes cleanliness and sustainability, as well as offering new reasons to go to business districts. So jumping to the next slide here, James. Here we go. The second major goal is to make it easier for New Yorkers to get to work. And the first strategy here is increasing the supply of mass transit options. There are a variety of different initiatives under this first strategy, but some of the main ones are creating a sustainable operating budget for the MTA, maintaining peak subway service, and also improving the frequency and reliability of off-hour subway service, increasing bus speeds, and investing in more protected bike infrastructure across the city. There will be a push to reduce the demand for cars and trucks, including congestion fines and things like that. And another effort to strengthen employment hubs and workspaces all across the 5 boroughs through investing in employment hubs, as well as modernizing libraries to support remote work. And the last goal here on the next slide is to generate inclusive, future-focused growth. Firstly, by establishing New York City as a hub for future industries and innovations. Secondly, and James sort of touched on this earlier, but they established for themselves a moonshot goal of creating 500,000 new units over the next decade to really address the housing crisis that the city is facing. So as the law currently is written, no development in New York City can exceed 12x FAR. But so if the state this is a state level cap, and so if that state cap were to be lifted, then city officials would be able to go in and, pick and choose which areas make sense for there to be an increased density of residential development. So for instance, in Midtown, where many commercial developments far exceed that 12 FAR, having larger residential projects would actually probably fit very nicely in with the neighborhood fabric and would make a lot of sense. And this goal also targets office conversions, especially the ones that James was mentioning earlier, where larger floor plates limit access to windows and light and air and really make it hard to convert. So removing this cap rate would allow developers to be able to tear down underutilized offices and build back larger projects than what are currently allowed. And again, there is talk here about a program to replace the expired 421A. So last year, Governor Hochul had proposed the 485W plan, which didn't make it through the budget discussions, but she has mentioned that, they're working on some sort of revised proposal here that we're yet to see the detail on, but hopefully, there is some sort of program that would further incentivize this sort of development, especially those containing affordable housing, excuse me. And this goal also outlines the need for larger FARs for affordable housing projects, amending of low density districts to enable for more production of units, and removing and reducing parking requirements across the city. And the last strategy here under this goal is to ensure that growth and access to opportunity is fair and equitable. And in the initiatives under this one, there's a lot of talk around affordable childcare and potentially having some sort of tax benefit for developers if there is some sort of childcare facility included in their projects.
Yeah.
Thank you, Ashley. Yeah, go ahead.
I was going to say, I think it would be helpful for you to explain what was in the 485W proposal that was rejected, just so that our people understand what was put forth and maybe gives them a sense of what to expect.
Right. So the last 421A program that we knew, the Affordable New York, there were 5, potentially 6 different options on different affordability requirements based on the location. But for the bulk of rental housing that was built, option C prevailed. And that was, although there was a 30% requirement for affordable, that was at 130% of AMI. And I guess the opposition said that doesn't constitute as affordable, because in many cases that produces a, $45, $50 a foot rent. What we need is deeper affordability. So what our governor put forth with 485W was really an attempt to provide deeper levels of affordability, reaching to make sure that providing for 60% AMI, so rents that were half or less than what the Affordable New York program did. So which we agree is very important. We need all types of housing. Again, if we're going to need over 500,000 units, we need fair market rate housing. We need all bands of AMI. So we certainly support the deeper levels of affordability. However, when you consider that based on land prices and where you can accomplish that, because based on construction costs today, we've seen several developer models, and we've worked closely with Rebney on this. When you are delivering affordable units at 60% AMI levels or less, you are having to clearly subsidize because that is not a profitable endeavor. So as a result, and we looked at one site that we sold in East Harlem and back under the old Affordable New York, and we ran it through the same model. And we sold that site at 250 a buildable foot. And once we ran it with the new rental requirements, it actually cut the land value in half. And some might say, well, these landowners, they're plenty wealthy, and it's still, why can't they still sell? And again, the fear I think is if you can't achieve a reasonable price for your land, you just won't sell, and you'll wait for the next for the future. And so
the alternative, sell to a condo developer,
right, or do condos. So I think with the 485 it was proposed, we could see that working, but certainly not in Manhattan, not in downtown Brooklyn, Long Island City, maybe further out in the boroughs, but
and that was rejected.
Yeah. So we'll see. Ashley, one question I was going to ask you is just kind of the give and take between the city and the state. And when I listened to the broadcast that Association for Better New York put on, it was really great to see the mayor and our governor up there on the podium together. I mean, they are definitely, lockstep barrel on this, where we've got the same goals, but just so everybody understands kind of, who's handling what. I mean, maybe talk a little bit what's under the city's purview and what's under the state's purview that for this to happen.
Yeah, so I think that a lot of this starts with the legislature at the state level, and the far left group in that body of government makes it hard for a lot of these real estate initiatives to really come to fruition. So that's why this is very much a proposal and not set in stone that these changes are going to happen. I know, for example, the FAR cap that's really a big push to lift that starts at the state level and would require the state to remove that cap before the city can then do what they will with that information and handpick, like I was saying before, which neighborhoods they think would make sense for the city to increase the density. So I think it probably depends on which initiative that we're looking at, but I do think that a lot of this starts at the state level, and we'll have to see what happens with the upcoming proposals of these bills and if any of this actually comes to fruition.
Perfect. So in closing, and then we do have a couple questions here I want to get to, but the first question is, when are we going to see a slowdown in the frequency of rate hikes? So, look, I wish we all knew. What I will say in speaking to many of you is the consensus is that, look, rates are going to continue to go up this year, and then they're going to come down in 2024. I kind of believe that that's kind of a dangerous mindset to be putting out there. If you are basing your investment decisions on rates coming down in 2024, first of all, none of us have a crystal ball. We don't know where this is headed, except for what we've heard our Fed chairman say, that it would seem that rates are going to continue to go up this year. And so I think we could see maybe 2 smaller increases. At least that's what seems to be the consensus. But as far as what happens in 24, again, that really to me starts becoming dangerous territory. I think one thing that we are starting to pay attention to, and surprisingly has not received a lot of coverage, is this debt ceiling discussion in Congress. And I'm going to just leave it at that, because I would encourage you all to just take a look and tell me what your thoughts are on that. But there's some major implication if Congress cannot get on the same page with that, or even potentially exceed that debt ceiling or allow that to happen, because that could have major implications on rates that I think would take a long time to play out. So I am certainly not an economist, but I also know that sometimes kind of we all go with this consensus and speaking to sellers, buyers who are just waiting to make decisions based on, 2024 when things are going to miraculously turn around. It seems to be a lot more complicated to me.
By the way, if you think it's going to miraculously turn around in 2024, right now is probably the time to buy.
True. Good point. So the other thing we're looking at, and this is a big theme, and in this month's white paper, we talked about 8 investment ideas for the new year, and a lot of these loans who are coming due, and forget about cash out refis. We're talking about cash in refis. So what happens to all these owners who do not have the ability to pay down? And they may very well have equity in these deals. I think we're going to see a lot of opportunities there on the sale front, whether owners are forced to sell, or we get a call, 3 calls a day from funds saying, hey, we've got a rescue fund that's putting together mezz. I mean, we're going to see a lot of that, and there's going to be a big need for it, especially in the office space, as many of these lenders are now starting to pull back in that category. So the last thing, and we've spent a lot of time on this office to residential conversion, so I don't think we need to, spend more time on that one. But we'll, with that, we'll go ahead and we'll go through a couple of questions here. So I'll pull this up. So Brandon, maybe you can field this one, asking about the profile of buyers today. Now, I know that really depends on, the type of assets, but let's just talk about the multifamily space right now. Has it been the institutions? Has it been private buyers? Has it been, the 1031s? Just, maybe tell us, who are the buyers who are active today?
Sure. I mean, we can even look at our, going back to our recent sales. So on the value add side, it's been predominantly dominated actually by, I would say, operators that are also have, let's say 100+ buildings or a large portfolio. They have capital ready to go at their side. It's not that they have to go raise it on a deal by deal basis. I think a lot of the groups that have to go raise capital on a deal by deal basis, as opposed to having the equity, ready to go if they see a good opportunity, that has been the dominant buyer of value add product. In the rent stabilized space, that would be more long-term holders or someone that, is just going to buy it and hold and clip a coupon. They have a good management team in place to operate these properties. And then on the renovated assets, it continues. The institutions, obviously, up until, call it Q4. I mean, this is for almost entirely foreign, high net worth 1031. I mean, I think that's a pretty consistent theme throughout any cycle. But you're really seeing it to a dramatic effect where, unless it's what we call the unicorn buyer, so many groups have pulled out, and these people also are coming in with a lot of cash, and they're usually buying properties between, call it $5 and $15 million, a little bit smaller of a check, but it's their own money, up to 25 million, but it's really their own money. And again, it takes a lot of work on our end to find these buyers, a lot of follow-up, a lot of networking within different pools of advisors who represent these groups, but it's definitely been driving the market in the multifamily space, and it's something we have to keep doing.
Yeah, I definitely agree with all that, and I have it never ceases to amaze me also with the amount of foreign interest, especially when there's times of uncertainty and where we see opportunity. You would think that would be the time that the local operators would jump in. But they're the first ones who say, we know too much. This doesn't look good. Where sometimes the foreigners say, hey, it's still New York, right? Yeah. And I'm taking a long view.
Can't see the forest.
Yeah, that's right. So I will, I'll take the next question asking if we are seeing any loan sales. Yes. Now, that being said, and I think back to 2009 and the depths of the, the financial crisis, and we were representing a lot of the big banks selling, loans for busted condo deals. We are not seeing a lot of that this go around. It seems like many of them learned their lesson. And, what we do see is a lot of these private lenders who came in but these are not just first mortgages. And I think kind of the difference of what we saw back in 2009 compared to today is this is going to happen a lot faster, because a lot of these private lenders, they said, no, we're not just going to sit here in a first mortgage position. We're going to also come and sit in, a mezz position where we have the ability to UCC foreclose, step into the, the borrower's shoes and take the properties a lot quicker. So, I mean, the discussions that we've had with lenders out there about loan sales, they don't really volunteer much of a discount off of par. So, I think, the bigger question again will be with office in some these cases where the building is obsolete and there's really, no ability to pretend and extend there. So we'll continue to inform you. But, the other thing is we call a lot of these community banks. No, we don't have any loans we're selling. And then we call you all, our clients, and say, what have you been up to? Well, I just bought 3 loans from my lender. And that's what you should be doing. If you are not calling your lender right now, asking them what loans they have to sell, if you borrow from them, you are going to have a much better chance than we are, because these lenders are not interested in, they don't want to air their dirty laundry, so to speak. I mean, obviously it's a different thing. We do a lot of work with special servicers, CMBS. I mean, if they've got to sell, there has to be a process, but with a lot of the community banks, sometimes your best bet is to go to them directly. Okay. So in the interest of time, I think we're going to just field one last question, which is, what is your favorite asset class to invest in? So, well, look, I gave 8 investment ideas, so I'll think about, what is something, and I'm going to double down on retail, and wrote a white paper on this last year, and we've already seen retail rents recover. In some case, it's doubled from the trough. In some cases, I said we've already reached rents that are back to where they were. And meanwhile, we're seeing some great cap rates out there. So some of these corridors, you're seeing very low vacancy, certainly Soho, even Madison Avenue for a while, which had a lot of vacant stores. So that would be my pick. Brandon, I know you're a multi guy, so
I think just on the retail, what I think is interesting is, and I do this when my wife wants to go out for the day, go into the stores. I think it's really interesting to see kind of how they've redesigned, like they're repurposing like what retail is. And that's kind of been one of my cool takeaways, is that they don't necessarily maybe look for the last dollar, but they're saying this is an affordable rent. This is good marketing exposure. And this is a new way that we could sell our product. So I think that's been really interesting, and you've seen success. I love multifamily. Why? I think if anything, the politics are starting to head back in the right direction. And I think that buyers they've almost scared themselves away in some regards, and not just seeing value. And I think we almost have the benefit of, we just finished COVID, where, every conversation in COVID, it was exhausting, where it's like, oh, the rental market won't come back for 3 years. And then next thing you know, one person buys, and the next person buys, and then people start coming back and prices shoot up. And it's like, I told you so. And it feels like the same thing again, where everyone's saying, no, this time's different. And I understand interest rates, but like, this isn't the first time that the U.S. economy's had inflation. It's not the first time that rates have gone up. Like, go look back at the 80s, go look back at the 90s. Like, this has happened before. The economy goes in cycles, and the people who buy low and sell high do the best. Yeah. And the people who kind of follow the herd, if they bought a lot of property in 2015, 2016, 2017, 2014, probably didn't do that well. And I think it's like, it's again, I understand it's hard to invest when there's fear in the air, but it almost becomes, it's like, just look historically, and I think people have very short memories, and I think it would be beneficial to kind of, again, try to see the forest through the trees.
Perfect. Yeah. And I know we both cited Warren Buffett in that regard before, about this environment where, yes, the good news for you buyers out there is that a lot of the competition's on the sidelines. So there will no doubt be opportunities this year. We're handling several estate sales, partnership disputes, distress. They are going to trade. And so when everybody comes back into the market, next year, 2024, when the hope is that things are going to, again, get a lot better, you'll also have a lot of competition. So with that, we really appreciate you all joining as always. And yes, we get the question. We will be providing you a recording of this. Happy to share the deck with you. I want to thank Ashley for all your work summarizing. I know this was not just a matter of, just writing down a couple bullet points. I mean, these documents are, in the hundreds of pages with these plans, very detailed. So thank you for keeping tabs on that. And we look forward to being in touch with you all soon. Thank you and have a great day.
Thank you.